This is Macro Horizons, episode 388, Active Style, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Vail Hartman and Delaney Choi to bring you our thoughts from the trading desk for the upcoming week of August 24th. As Bessent's latest attempt to contain longer-dated Treasury yields has come under scrutiny, the market has said farewell to the regular and predictable mantra and is adjusting to a more active approach from the Treasury Secretary. Vol's long goodbye. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there was a clear theme toward higher Treasury yields, and it was interesting that the price action occurred at a point when the economic data continues to suggest a slower trajectory for the U.S. consumer, a labor market that is showing some signs of stress, and relatively benign inflation figures overall. It's also notable that the bear steepening occurred in the wake of the weaker-than-expected retail sales data from July. So much of the week just past was spent watching rates grind higher, even as the fundamentals suggest that there's plenty of cross-currents in the real economy to prevent the Fed from hiking rates in September. Of course, the FOMC's ultimate decision will include the August payrolls and CPI figures, which have yet to be released. The most notable development in the week just past, however, was the decision on the part of the Treasury Department to increase the size of its liquidity support buybacks in the longer end of the curve. Specifically, the Treasury Department announced that the Treasury is increasing by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities, the 10 to 20-year sector and the 20 to 30-year sector. So, in total, the Treasury Department was purchasing up to $38 billion this quarter, and the increases will add at least an extra $14 billion. Now, the longer end of the Treasury market initially rallied on this news, but that price action was ultimately challenged because, after all, an additional $14 billion of buybacks over the course of a quarter is not being viewed as sufficient to offset the true fundamentals that have driven longer-dated yields higher. Headlines noting that the U.S. Treasury debt has now exceeded $40 trillion undoubtedly added to the fiscal concerns that were already in the market. Moreover, the fiscal story is not limited to the U.S. Concerns about sovereign borrowing in Japan, in parts of Europe, and the UK have been in place throughout the course of the last 18 months, and as we watch the long end of the Treasury curve continue to struggle, we're reminded that investors have the luxury of trading the fiscal side only as long as risk assets are well behaved and the perception is that the underlying U.S. economy remains on solid footing. The week just past also contained the FOMC minutes, which noted that most participants anticipated that inflation would step down over the rest of the year as the effects of tariffs and earlier energy price increases wane. But many participants noted the possibility that inflation might be more persistently elevated. It's that risk that has left the prospects for a rate hike between now and the end of this year on the table, although we're very much in the camp that they're not going to hike in September, and if they don't hike in September, then it's very difficult to justify a move in October, given its proximity to the midterm elections. Therefore, if the Fed skips September, the next truly live meeting will be December. And a lot can happen in the trajectory of the real economy between now and December.
Despite the lack of top-tier economic data, we saw fairly significant price action in the Treasury market this week. The yield curve bears steepened in the front half of the week, with 30-year yields touching their highest level since June 2007. But Wednesday saw the Treasury Department announce an increase to the sizes of nominal long-end liquidity support buybacks starting from September 9th. Specifically, the Treasury announced that it will be raising by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities, and that's the 10-year to 20-year sector and the 20-year to 30-year sector. Bonds rallied nearly 10 basis points, and the 5/30s curve retraced much of the steepening seen over the month of August. However, the question remains as to the durability of the move, given that the bearish fundamentals underlying the sell-off in duration, which include the deficit, funding needs, and a higher R-star, among other concerns, haven't changed.
And we can see that playing out in real rates. Real rates remain elevated, and that's the story of what happens if we find out that the U.S. economy can withstand an energy shock, and the U.S. economy can withstand higher realized prices for goods and services for a longer period than previously assumed. Then potential growth might be higher. And therefore, it follows intuitively that longer-dated real rates have been drifting higher over much of the last several months. It is also worth observing that we've had 2 solid quarters of real GDP growth, with the most recent quarter revealing a return of the consumer to an elevated pace of spending, which is clearly a net positive when we think about momentum coming into Q3. As it's currently tracking, real GDP is above 4% for the quarter. Now we're still early in the data cycle, and given the trajectory of retail sales, we would expect those ambitions to moderate a bit, but growth is still in positive territory. The AI build-out is still a meaningful contributor to forward GDP expectations, and by and large, the equity market has been holding in remarkably well.
And on the margin, we've seen increasing signs that the consumer may be coming under pressure with the U.S.-Iran war currently on its 6th month. Recall that on top of the decline in July's retail sales print, we've seen the yearly pace of real average hourly earnings drop in 3 of the last 4 months. And trends in survey-based series also indicate that the decline in real purchasing power is a key concern amongst consumers. This can be seen in the preliminary release of August UMich Sentiment Survey, which mentioned that across all consumers, only 8% expect their income growth to exceed inflation in the year ahead. And these are just a couple of signs that consumers are struggling with elevated prices at a moment of declining real purchasing power, a concerning trend when taken in the context of a fragile labor market.
And there are, without question, cross-currents in the labor market data. Recall that there was an unexpected decline in the unemployment rate in the month of July, which was yet again a function of subdued labor force participation. The labor force participation story isn't limited to baby boomers simply moving on to retirement, but we are also seeing prime working age employees leaving the labor market in that 25 to 55-year-old cohort in particular. So part of that might be an AI story, part of that might be the wealth effect prompting dual income families to shift to single income families. Part of it might also be a quality of data issue, as certain participants in the real economy might feel less compelled to engage in government surveys given the tone of immigration reform. So if nothing else, we're somewhat concerned about the reliability of the unemployment rate at this moment. Similarly, July's negative non-farm payrolls print raises questions about what's really going on in the labor market, especially in the context of negative real wage growth. So there is arguably a bit of a disconnect with the bond bearish sentiment that has been evident not only in the US, but also overseas, including Japan, Europe, the UK. And we anticipate that this disconnect will remain in focus until at least we have the August payrolls figures, which will be released on the first Friday in September.
And on the other side of the Fed's dual mandate, the upside risks to inflation were a key focus within the FOMC minutes, although it was notable that the majority of the committee anticipates that inflation would step down over the rest of the year as the effects of tariffs and the energy shock wane. Even then, a large majority of the committee noted the possibility that inflation might be more persistently elevated. While Kevin Warsh said there was large majority support for the decision to hold rates steady last month, The minutes said that the committee thought that the information that would accumulate during the intermeeting period could provide more clarity and correspondingly reduce uncertainty about the inflation outlook. In other words, the committee broadly believed that the July and August inflation data held the potential to confirm whether higher rates would be needed to bring down inflation. Of course, the July 29 meeting took place before the latest inflation data, and with the 3-month annualized pace of core CPI down to 1.6%, there is a high bar for August inflation data to justify a rate hike on September 16th.
We're also watching financial conditions very closely because Warsh's comment that the market is doing a lot of heavy lifting for monetary policymakers, while it did trigger a steepening in the yield curve and raise some concerns about the circular nature of the logic, the reality is that despite Bessent's attempt to contain longer-dated rates, there's been a persistent bearish tone further out the curve, which will, at least on the margin, contribute to tighter financial conditions. The flip side and wild card in this scenario is how risk assets, particularly the equity market, performs between now and the September FOMC meeting. In the event that we're at current levels or continue to move incrementally higher, financial conditions will be easy enough that the Fed will have the flexibility to respond to the economic data for the month of August, assuming that they deem some change warranted. However, in the event that near-term weakness in the equity market manages to materially extend over the next several weeks, the market will then have, in effect, been doing further tightening for the Fed, and in keeping with Warsh's comments, reduce any urgency to hike rates in September. When we think about what's priced in for September at the moment, odds are roughly 32 to 35% that the Fed will actually increase 25 basis points. Given the uncertainty created by Warsh's pushback against forward guidance, we suspect that at the end of the day, the floor for pricing in a non-consensus outcome immediately ahead of a given FOMC meeting is higher for the Warsh Fed versus a Powell Fed or a more typical approach to forward guidance. So in practical terms, this means that even if we get a disappointing payrolls and CPI combination, that we still think that the floor for pricing in on the eve of the September FOMC meeting, a 25 basis point rate hike, is somewhere between 20 and 25%. Said differently, the 2-year sector only has so far that it can rally on data alone. It would need a definitive tone shift from monetary policymakers that is unlikely to be delivered given Warsh's stance on forward guidance.
And further out the curve, a factor that's been limiting the ability of duration to rally is corporate issuance. Even though nominal coupon auction sizes have been left unchanged for the past few years, the corporate bond-driven growth of duration supply in U.S. fixed income has emerged as a structural headwind for the long end of the Treasury market. The monthly supply of U.S. investment-grade corporate bond issuance has reached a new August record at more than $150 billion month to date, surpassing the previous record of $136 billion set in 2020. August is the 4th month this year to set an all-time record in terms of new issue volume. The record pace of corporate bond issuance has been competing with treasuries for investor demand and left many on guard for evidence of supply indigestion, although the August refunding auctions were smoothly absorbed, reflecting ongoing end-user demand for treasuries despite the ongoing backup in rates.
And another bond bearish factor in the week just past, at least, was geopolitics, yet again driving energy prices higher. This has been an ongoing theme, and we suspect that investors were willing to look beyond the conflict in the Middle East as long as energy prices managed to stay contained within the prevailing range. But as the front-month WTI crude oil contract starts to move closer to $90 a barrel, we're reminded that not only is this a energy supply and demand dynamic, but given Bessent's decision to increase the buybacks and the subsequent decline in the value of the U.S. dollar, the fact that oil is a dollar-traded product implies higher prices, as well as the risk that the U.S. could soon shift back into the mode of importing inflation.
And speaking of rising oil costs, there's been chatter about the fact that the spread in pricing between a barrel of crude oil and the diesel that's refined from it has reached a fresh all-time high. And that measure reaching an all-time high at a moment when the front-month WTI contract is still trading well off the early March peaks speaks to the fact that even if we were to see a deal between the US and Iran today and the flow of oil were to return to pre-war levels, it wouldn't necessarily imply that the cost of refined fuels, like diesel and gasoline, would also return to pre-war levels imminently. Attacks on refineries in the Middle East and Russia, combined with the slowing in the flow of oil supply, have significantly reduced production capabilities, and reports indicate that around 9% of global refining capacity is currently offline. And this discrepancy can be seen in the fact that even though crude oil is more than 25% off the peaks from early in the war, the average price of diesel in the US is less than 5% off the highs. And the severe upward pressure in fuel costs is particularly concerning when taken in the context of the food cost component of inflation, as harvest season approaches and global refining capabilities remain well below full capacity.
So, if nothing else, the market is justified in waiting for future inflation reports to see whether or not the June and July benign numbers were simply the one-off or the exception that will be reversed during the balance of the year. This dynamic certainly does leave more questions than answers as to what we should expect in terms of future changes to Besant's effort to control the longer end of the yield curve.
The decision to boost buybacks just 2 weeks after the August refunding announcement, i.e., outside of the U.S. Treasury's regularly scheduled quarterly announcement, is a clear signal that the bond sell-off had reached a significant pressure point for the administration. The abrupt nature of the announcement has understandably raised concerns about the lengths to which Besant is willing to go to bring down longer-dated yields moving forward. This effectively sets up the November refunding announcement to be more of a wild card than otherwise might have been the case. Will Besant's next move be to cut bond issuance? Will the statement hint at a future shift in the issuance mix? Will buybacks be upsized yet again? If nothing else, Besant's interventionist approach has introduced a new set of risks and uncertainties for the near-term issuance outlook. Larger buybacks in the 10 to 30-year sectors are likely to be funded through additional T-bill issuance. For the current refunding quarter, doubling the size of long-end buybacks implies an additional $14 billion of T-bill issuance, although there is ample upside given that the Treasury Department said that buybacks would be increased by at least double. In the event that double-sized long-end buybacks is the new norm beyond the current quarter, then quarterly T-bill issuance would be $16 billion greater than previously assumed. And in a scenario where buybacks were tripled, then that would mean an additional $32 billion of T-bill issuance on a quarterly basis. To be sure, doubling the size of long-end buybacks wouldn't have a dramatic impact on the overall market supply of bills, even if it does imply modest upward pressure on funding costs. More importantly, upping the buybacks doesn't change the broader fundamental backdrop that's been responsible for pushing 30-year yields well into five-handle territory this summer. For instance, the bond bearish underpinnings of ever-increasing deficit spending are here to stay. The Treasury Department had presumably assumed that doubling the buybacks would draw an implicit line in the sand for 30-year yields by demonstrating that the administration is willing to come off the sidelines and take a more interventionist approach if it thinks that bonds are oversold. Clearly, there is skepticism in the market that Besant's decision will effectively contain 30-year yields, given that the announcement hasn't led to an extended bond rally.
Well, at least one thing can be said, and that is that skepticism remains a mainstay in the U.S. rates market, and we anticipate that it will for the foreseeable future.
Really? Are you sure?
I think it's a hoax.
You guys are just skeptics. In the week ahead, the Treasury market will have plenty of potential triggers for price action. We do see July's core PCE figures. Here, the Fed's favored measure of inflation is expected to increase 0.2%. While this might not get inflation back to the Fed's target, it certainly is not as troubling as if we had been facing a materially higher print in the context of the recent energy shock. The market will also take down the final nominal coupon auctions of the month. There's 69 billion 2 years on Tuesday, 70 billion 5 years on Wednesday, followed by 44 billion 7 years on Thursday. the biggest events on the monetary policy front will come from the Jackson Hole Fed Symposium. This year's topic is financial innovation, implications for payments and policy. So within the scope of the discussion, there would be the potential for Warsh to offer some forward guidance in terms of how the committee might view the trajectory of inflation and the employment statistics from June and July. However, we're not expecting a U-turn on Warsh's pushback against forward guidance. That doesn't mean that there won't be potentially tradable headlines that come out of the event. But at the end of the day, the Fed will still need the economic data for the month of August to justify a decision to hike rates in September if the committee ultimately decides that is warranted. Beyond these marquee events, we'll note that the BLS will also be releasing its preliminary benchmark payrolls revisions on Friday morning, which, given the recent trend of revisions to be sharply negative, could potentially serve to recast the market's understanding of the current labor market conditions. We'll also see the personal spending figures for the month of July, and in light of the disappointing retail sales numbers, the consensus of 0.2% for personal spending suggests that what was lost on the goods side was likely made up in services. Nonetheless, we're at the point in the cycle where any strain on the consumer could have more meaningful ramifications for the trajectory of real GDP going forward. In the context of the near-term trajectory of Treasury yields, it's not lost on us that the fiscal emphasis of the price action suggests that we could see more weakness in the medium term. It would most likely come in the form of a bear steepener, keeping in mind that the front end of the curve, particularly 2-year yields, are going to be very closely correlated with monetary policy expectations, and given the uncertainty about whether or not the Fed will hike in September, we expect 2-year yields to remain in a relatively tight range. As a result, the shape of the curve is going to be effectively a directional trade. So either a bear steepening in the event that the fiscal concerns continue to dominate the narrative at the moment, or a bull flattening in the event that the economic data disappoints and questions about the longer-term trajectory of growth come into focus once again. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the Jackson Hole Economic Policy Symposium is set to begin on Thursday, August 27th, we're growing increasingly convinced that our invitation might, once again, have been misdirected elsewhere. Perhaps it was accidentally sent to the Micro Horizons podcast crew. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.